How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you life insurance retirement plan and what you should really know regarding the life insurance retirement plan to avoid some of the most common mistakes made by individuals, thinking that everything about this type of plan is just unbelievable. Because there are certain ways that you could set up a cash value life insurance plan to leverage for retirement income or retirement planning, but you have to be very mindful of a couple of different ways to make sure that you're not throwing a lot of money down the drain, because the ways that these are set up, you have many agents that could offer life insurance retirement plans or cash value life insurance products, and majority of these advisors set them up the complete wrong way, just with their primary focus to make an agent commission. So I want to show you the little techniques, the little ways on how cash value life insurance plans work, regarding how to max out that cash value, how to make sure that you're minimizing that cost of insurance and all those other, miscellaneous expenses that come with the cost of life insurance or permanent life insurance to make sure that the dollars are going into that cash value as much as possible. First off, one of the reasons why somebody would like a cash value life insurance plan would be because the way that that cash value is going to grow, it's going to grow tax free. All the accumulation, all those extra dollars that are going into your cash value are going to grow tax free. Any sort of credit that is going to gain within that account on top of everything that's being placed within that cash value that's going to grow tax free. You're going to be able to leave a tax free death benefit to your beneficiaries. Typically, these are a lump sum death benefit amount would go directly to your beneficiaries. So therefore, that's always good to have that, primarily as an asset for asset protection for your family, for any beneficiaries. And then the very lastly would be tax-free income at a later date. Now, when individuals are looking to take money from this cash value, there are specific criteria that need to be met and a specific procedure that needs to be met in order to pull out this money safely and make sure that you're not getting hindered with taxation and making sure that you're able to receive it, in the largest amount possible. So a typical life insurance plan or a cash value life insurance plan works that an individual would go place money into a plan. So kind of think of this little egg shape as a life insurance plan. Now, you have your different miscellaneous expenses within this type of plan. These expenses are going to take care of that death benefit that is being offered to the individual. So you have an individual, and just mind my stick figure over here, is going to pay money into a plan. You have a portion of it which is going to go to your cost of insurance, is going to go to your mortality expenses, all these administrative charges into your plan. Anything that's remaining is going to go into a secondary bucket, which is kind of like a savings account known as cash value. So whenever you have agents that are talking about life insurance as a retirement plan, they're discussing this cash value. Now, one of the most important things is, okay, how do you know whether this cash value is going to be growing favorably, or whether that illustration that the advisor is giving you is just BS? And excuse my language, but you obviously could hear the frustration in my voice, because these products could work really, really well when designed correctly, but unfortunately I've come across many times that advisors set these up the wrong way, and they do not know anything about these policies, and they're just so focused on the death benefit when an individual might not be concerned so much with that max death benefit and would be more concerned with just that max cash value. So if you kind of look at this little egg shape, the little chicken scratch egg shape that I put up there, you see a large portion of it is going towards those different expenses, towards that cost of insurance, towards those administrative charges, and that smaller portion is going into that cash value. So the different things that determine how large this cash value is going to be at the end of the day, at the end of the year, is the amount of extra premium dollars that are going into this bucket, and whatever the specific interest rate that's being credited to that cash value. And this is where you have different cash value plans. You could have a whole life insurance plan, which this interest credit that gets credited on top of that cash value is going to be dealt with through something known as a dividend rate, and it's kind of like a fixed rate, a fixed interest rate that would go into that account year by year. That's through whole life. You could also use something known as universal life, which is tied to interest rates. Nobody uses universal life anymore for that accumulation because of the fact that interest rates are at all-time lows. You have variable universal life, which it has it linked more to mutual funds. So the credit could either be a positive or the credit could be a negative, depending upon how that mutual fund performs. That's the third option. And the fourth option that I really like using, and this is what I have for my own money, is something known as an index universal life, where you're utilizing indexing strategies that are linked to stock market indexes that is either going to give you a positive credit, or it's going to give you a credit of 0%. So you always have that floor of 0%, but you're able to gain double-digit gains in a given year, with all the extra dollars that are going into the cash value. So you could have the extra dollars that are going into the cash value and the interest credits from that index, that we know can never be less than 0%, that is also being credited into that cash value, so that you have that accumulation. So when a plan is set up the right way, your accumulation in your cash value is going to be growing at a very rapid pace. So you're going to be very happy with your performance because it's going to be growing in a tax-free manner very rapidly. Your death benefit is still going to go to your beneficiaries, and it's going to be higher than anything in your retirement accounts, because that's fully taxable at a specific with a specific way. And then the income when you're ready to retire, typically with retirement accounts such as 401ks and IRAs, you have to wait till at least age 59 and a half, and something known as a 59 and a half rule, to start pulling distributions from those accounts. With these cash value plans, you could take out money before age 59 and a half. If you want to start retiring at age 40, if you want to start retiring 45, 50, 55, you could pull this money out, in a tax-free manner. But you have to understand exactly how to do that. So certain things that when a cash value plan is not set up properly is just like that little egg shape. Remember, you will have an agent that could set up all the expenses to make up majority of this type of contract, so that you only have a small amount towards your cash value. So the way that an agent could do this, and when they do this, they take away from their agent commission. So that's why it's not going to be a frequent recommendation, when agents set these up. Majority of agents out there, they're looking to make a quick buck and then get out of the business. This is meant specifically for the individual that says, you know what, I understand all these tax-free components. I understand all those benefits. I want to have something that gives me the lowest possible death benefit, but with the highest cash value accumulation in there. So that's why we try to set up the plans where we have the lowest in expenses and the highest in cash value, so that for every dollar that goes in, yes, a portion of it has to suffice those expenses because it has to still be under the house of life insurance. If not, it's going to go over the modified endowment contract limits. And I don't mean to get technical, but that's one of the things that in order for it to be deemed all these tax-free benefits, they have to make sure that this is known as a non-MEC policy, to make sure that it's not falling into a modified endowment contract, because back in the day, individuals were able to throw large lump sums into these cash value plans and have a small death benefit, and the government obviously realized that, all these people were just making money hand over fist and they weren't paying any money in taxes. So now there has to be a complete correlation between cash value growth and death benefit to make sure that you're sufficing the IRS guidelines at the same time. So what we try to do is make sure that we're pushing the limit. We find all the best carriers out there, depending upon your age, depending upon your state, depending upon how much you want to put away, either on a lump sum basis or on a monthly basis, to make sure that your dollar amount, yes, a small portion would be going towards those expenses to suffice that. A large portion is going to be going towards that cash value accumulation, so that when this is accumulating, it's accumulating off the power of compound interest. And when you're ready to take out this money, you're able to take it out in a maximized tax-free manner. So, those are just some little steps. So the ways that when these things are not set up properly is you have agents that set them up where they have too high of expenses, they're too high with front-end loaded fees, they're too high with surrender charges, and all you're doing is just throwing money down the drain. You're just throwing money into a death benefit maximization plan. And with that being said, you could go into something known as a GUL route, or you could go into a laddering strategy with term life insurance and save thousands upon thousands of dollars in the process. So, if you're looking primarily for that cash value plan, you want to make sure that this is set up the right way. And this is one of the things that we have with our company. If you're looking for cash value maximization, and this does this does suit your needs, or you found this video to be interesting, please feel free to give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service on weekends and also on holidays. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of our methodical process. We utilize a certain planning system known as the Retire Sharp planning system. It's proprietary to a Fosse Financial Group. Nobody else has this, where it allows us to go through over 300 plus different contracts and multiple strategies, so that on average we're going through over 1,200 different policies and strategies before we're giving our top three recommendations on what's the top three, either life insurance plan or max cash value plan, what would work specifically best in your state for the dollar amount that you're looking to place on a monthly basis or an annual basis or a lump sum, whatever that is. But the worst thing that you could do is just go into a cash value life insurance plan blindly. You want to make sure that you're dealing with experts, that you're dealing with people that deal with these plans on a daily basis. And this is why we have a large volume come into our office regarding these cash value maximization plans. And these are the types of plans that I have for my own retirement. And it's because I understand that taxes most likely will be going up by the time I retire, and I want something that's not going to lose whenever the market goes down, and will still accentuate my growth whenever the market goes up. So for my own plan, I made sure to strip away all those costs, just like I'm recommending to you guys, to make sure that my cash value is as high as possible. Something, God forbid, something happens to me before I'm ready to start taking distributions, my wife is going to be able to, and my family is going to be able to receive, a tax-free death benefit on the back end. By the time I retire, I'm going to be able to now take out distributions on a tax-free manner. So, those are the beauties of these plans. But, there's a lot of traps, and there's a lot of advisors that do not know how to set this up the right way. And I don't mean to bash anybody. It's a very realistic scenario. You want to make sure that you're with a very credible company, and, somebody that's out for your best interest. So that's what we try to do with, these free educational pieces, with literature pieces. And feel free to give us a call at any time, and we'll try to help you out best we can. Thanks so much, guys.